Well, welcome to the Inside Australian Property Podcast. I'm Rob Elliott from Lansdowne Property Group. We've had the budget last night. There was some good stuff, some scary stuff. And I thought if we're going to talk about it, let's get someone who actually knows, lives and breathes finance. Michael from Mencken Finance, welcome.
Thanks for having me here.
Mate, no problem. Before we get into it, tell people a little bit about your business and what you do.
Yeah, sure. So Mencken Finance, we're a brokerage that has been running for just under 2 years. We'll be turning 2 in July.
Yep.
We have a team of over 50 years of banking experience, 40 years in leadership in finance as well. We operate out of Sydney Southwest in Camden, so come see us.
Come see it. Yeah. And you've got some amazing software that powers your customers to help them make really good decisions around investments, around property. As you said to me the other week, knowledge is king when you're looking after your clients. You're very proud about how well you do. Looking at the budget last night, overall, before we get into the property side, what are your thoughts on the budget?
Look, it was as polarising as one I've ever remembered, and I think I'm disappointed for a lot of the Australians. I'm disappointed for Gen Z and some of the investment strategies that I got a lot of benefit from and could utilise in previous generations. I think that the door's been shut on them. I think there's been a few more other changes, but still a lot of questions come out. I'm sure we'll go through a few of those topics in a bit.
Yeah, it was an interesting budget. The government has come out and said they're trying to do intergenerational wealth adjustment. They're trying to get first homeowners back into the property market, but they've been out for a long time. You can't blame the war. This started probably 2-3 years ago, and it hasn't got any better. We'll get straight into it. Investments. CGT, capital gains tax, they're removing that effective 2027. What effect do you think that'll have on the investment market, and where do you think it'll affect investors when they're looking on what to buy and how to buy?
Yeah, right. So with capital gains tax, obviously the 50% exemption flat that rewards Australians for holding a major asset class longer than 12 months, that's going. And I'll probably assume that the listeners can understand how that used to work. But they're replacing it with something called the inflation indexation model, which is where it would be indexing the inflation for the holding period of the asset. Just say, for example, we buy a property at $1 million in year one, and we hold it for 5 years. Over that 5 years cumulative, there was 25% inflation. And the cost base was $1 million, including costs.
Yep.
We'd have 1,250,000 if we include that inflation, if we indexed it. If we sold it for 1.5 million, it'd be 1.5 million sale price minus the index cost base. We'd have 250k capital gains effective to add to your taxable income. So it's a more straightforward, no concession kind of model. It will hurt some investors, but given the conditions in the market, I wasn't too opposed to this. Where we look at the international conflict, we look at some of the things that are out of our control. We talk about the 11 categories of inflation, one of them being transport and the oil supply disruption that's going on overseas and how it's impacting our measures. That's something that will probably be taken into consideration further with this new model. So time will tell, and I think let's see how it all kind of works out and unravels. But for now, it looks like they've just taken into consideration one of the biggest talking points, which is inflation, and like they've shared in data over the next year, that it will rise to about 4.8%.
They tried to get rid of CGT years ago and repeal it within 2 years.
Yeah.
New Zealand and some of the other countries have tried to do it and repealed it within 2 or 3 years because it hasn't worked. Apart from other members, it's pushed rents up, it's hit supply. Overall, we're talking in general, not specifics. Do you think there is a possibility that, and we're going to get on to negative gearing in a minute, do you think when you look at the whole budget and this, that could happen in Australia?
That they bring it back in?
That supply does contract, especially for investors, and then renters have got less places to rent, which will push rents up. This morning, they were saying last night they were going to go up $2.50 a week, where this morning a lot of the pundits in the investment industry were saying 15% over the 12 months because of the increased costs. They won't be able to write as much off.
Yeah.
And people are going to maybe look at other ways to invest their money.
Absolutely. Well, with the changes that come in after the 1st of July to negative gearing, established properties have the grandfather policy. Old rules still apply even though new changes come in, is what grandfather basically means. And so that existing stock, a lot of investors will be reluctant to give up those legacy kind of rights, and they want to keep them intact. So that would give immediate impact to the stock and just being less stock being put on the market. We've already notoriously had supply issues and just not keeping up to the pace with what the government has committed to delivering in terms of supply housing. We've just committed to building another 100,000 homes in I think it's a $3 billion budget dedication toward. And I just want to understand, first of all, where do we find the builders? And the second part really is, I'm sure we're going to talk about negative gearing in a bit more depth, but with negative gearing, one of the main points about it is that investors don't mind operating it at a loss because there's the tax benefits of running it at a loss and reducing your taxable, your tax payable. But if that all goes, there's not much incentive to run it at a loss, and you can now pass on the cost to tenants.
They've got to get it back somewhere.
Absolutely. So I feel sorry for the tenants and the lower to middle class of the world. We're losing one of the we're starting to lose a grip, and we're starting to see a lot of the pressure pile onto them, and it was apparently sold and designed to help these people. So
yeah, a few people have said, why is it so wrong for people to invest? And I've got people, as young guys and ladies, who are still living at home or renting, and call them rent investors, you and I know, where they rent and invest because they can't afford to buy where they're living and working. And what they're trying to do is to make a bit of money so they can buy a home. And other people are trying to make a bit of money so they become self-funded in retiree. Now, isn't it better for them to be self-funded when they retire than to be on the pension? It's got to be better for the government.
Absolutely. Look, without a doubt, mate, like you do this as a profession yourself, and, I'm sure your listeners understand what sort of part you play in the property game. Like this is what you do day to day. But it's just so interesting that, first of all, it was the intergenerational gaps that they're trying to, or inequalities that they're trying to address. But effectively, yourself and I, they talk about investors versus first home buyers and baby boomers, Gen X, Gen Y, getting all the opportunities. But they've effectively just shut the door, I feel, on Gen Z or the new investors coming into the market after last night. And they won't be able to use the negative gearing benefits. From a mortgage broking perspective, negative gearing is a huge part to play in borrowing capacity and serviceability. So
it is,
pretty keen to see how the lenders, we don't effectively know right down to the detail how lenders will react, but we understand that we've got 13 months left of a grace period if you buy an established property from today onward up until 1st of July, and then it will be wiped if it's an established dwelling. What does that look like from a borrowing capacity? And lenders will likely not allow you to use that over an average mortgage term, which is 30 years. It just doesn't make any credit sense. And you still have to, these lenders and banks still have to meet their responsible lending obligations. So I think there's going to be significant cuts to borrowing capacity.
I heard that last night already.
Yeah.
One of my clients was looking for a property which I thought I'd secured for them. And I work, as you know, I work very close with the mortgage broker, and we bounce the figures off each other to look after our client.
Absolutely.
And I say, well, this is what my costs, and I work it out with stamp duty. So can you go and check it against your val? And he came back to me and said, yes, you're right, Rob, but because of the interest rate rises and what's happening, they've just lost 1.5% of their borrowing power.
Yeah, insane.
So what do we do? I mean, if you're looking at, you're saying that basically June next year, all bets are off, it's all gone. Could you have a situation where investors start dumping properties before the end of the financial year next year because negative gearing is gone?
Yeah, it could be a possibility, but what I'd really think is, first of all, I think a lot of the demand and investor attention will shift to new dwellings. I think the established dwellings after last night will probably curb a little bit, and I don't think it'll ever go completely the other way, but I think it will definitely cool down. But with the property prices, I think they're still going to be taken up with the new builds that seem to floor different suburbs. We've seen it out west here, Austral, Leppington, with the airport corridor and the new tarmac coming at the end of this year. That Austral, Leppington, they've been the established dwellings, 4 bedrooms, 500 metre square blocks. A new developer comes in, ready to settle 200, 300 new house and land packages. Once that's settled and they're listed as comparable sales, that drags up the existing dwellings prices, and it'll continue to do so.
A brand new home on a 500 square metre block, 400, is 1.2 million.
Yeah.
Now, they can turn around and say, well, the investors can buy them. But when I spoke to, I think, 5 or 6 of my friends who are buyers agents up and down the east coast of Australia, they said the average investor is between 700,000 to 800,000, which is where the average renter is.
Yeah.
So to say, okay, I'm all for improving new builds and getting construction up and getting new homes, but when the average price is 1.2 million for a house or 800 to $1 million for a unit that may take 3 years to build and then hope the developer doesn't go bust halfway through, I think there's a bit of a disconnect there. We have to improve supply.
Absolutely.
But the price isn't moving. I mean, a developer said to me the other day it costs $130,000 a block to bring it to market without the cost of the land.
Yeah, absolutely.
Now, that's ridiculous.
Yeah.
I
Insane.
mean, where do we go? What do we do?
Look, you brought up important points there, because obviously builders still take on a lot of risk and have so much pressure to provide the suppliers. And I worry that, because we asked the question earlier, where will these builders come from, that we need top professionals delivering these homes too.
We need good quality product.
And sometimes it can be inviting a compromise to the product to be able to deliver at the speed that they need. That's one, if they ever do meet the supply demand, which I believe they won't. The other thing is with the supply chains and material costs that seem to be continuing to grow, builder margins might actually grow from about the 15 to 20% to the 25 to 30% by end of 2027. We're going to see that the costs will fly up, and in turn, this seems to have all the investment attention. It's just going to keep driving further up, and it just comes back to that same concern, the Australian dream, to own a house, housing affordability. Yeah. When we go back to square one, does it really help housing affordability? And the answer is no. So that it's just still the lingering issue. Where we go, I hate to pose a problem without a solution, but in the 1985, I believe, was the Keating and Hawke government when they scrapped negative gearing. Yes. They made drastic changes to the property and lending market. It was only 2 years later that they had to bring it back in. The investor lobby was very strong, impacted too many Australians. The rental costs
went through the roof.
And history. The history probably gives you a bit of evidence as to what we can see in the future at times, and I don't see how it will play any different. So I really hope that from here, that I'm wrong and that you're wrong, and that it doesn't have the impact to the Australians and the tenants and even and our investors as it looks like it will. But if it does, that we're pretty quick and we're agile as a nation, first with the public, to hold our members and our politicians to account for some of these changes, and two, that we're agile enough to undo any of these changes and move back to what worked again.
I was watching last night, you're talking about holding people to account. It's not just the politicians. I was looking at all the major indices that you and I look at, GDP, wages growth, rental growth, all of them. Yeah, and the RBA was on one level and Treasury was on another level, and they weren't even close.
Yeah, right.
Now, they're both based in Canberra. Yeah. They're both basically doing the same work. I know what the RBA prides itself on being independent from Treasury, which is the bureaucracy. But there was so much of a disconnect. Now, Treasury are advising the politicians and the people on what needs to be done to run the economy, but the RBA has already come out and said they've got to cut spending. Now, even the growth targets of Treasury versus RBA don't match. Do you think that may be part of the problem, where we're looking for a solution, but not everyone is really on the same page?
Oh, absolutely. It's so interesting how different ideas can run for the people that are running this country, that there could be such diversity. And I was looking at coverage yesterday, and it was about the lockup That happens
Yes,
an hour
the
before.
budget line,
Yeah,
yes.
yeah, yeah. And
Yeah.
it's just so interesting because the way that they pose it, it's kind of like, it's all just data, to be honest. But it's kind of like,
It used to be that was because they didn't leak anything. Now they leak most of the budget,
oh, yeah.
and then see what people are saying and allows them then to change it if there's too much pushback.
Yeah, absolutely. And where I want to go with this is that such a differing opinions, and they may want to drive a certain change, but this lockup, what it seemed like to me, and I could be very wrong, but what it really seemed like to me is it looked like they were just in a room to say, hey, we get pressed on this. This is our united stance, and this is the message that we should be sharing to the public. And we were always on this from day one, or we were always united on this. And it's just ridiculous, right? It's just data, and I think that's an element of a politician's life.
So we don't know if this will all get through the way it is, but let's look to 12 months' time, and we're a couple of months out from the financial year.
Yep.
And you know that negative gearing is about to go. And I come to you as an investor and say, okay, Michael, negative gearing's going. This is all going to change. Should I buy a property, or how would I structure it? Do I need to put the property into a company? Do I need to go into a self-managed super? If I'm looking at an $800,000 house in Orange that's going to get me about 4.5% gross yield, what do you do? What do you tell them?
Yeah, absolutely. It'd be very, very different for each and every person that's in front of you and their circumstances.
It is, yeah. Because we don't give financial advice, you and I.
Yeah.
We just give,
absolutely.
what the lay of the land is.
Yeah, data. I give credit advice, but I'd always advise them to go seek some professional financial advice, and I think everyone listening who's interested in this should. But more importantly, company holders, company property buyers, they were never impacted by this. Negative gearing never really was a play for them, so it's kind of a moot point for them.
Yep.
You can still have income in and running costs out like a business does or a company does. So you can still factor in losses and whatnot as deductions in there, and there's a company tax rate that gets paid, so that can be beneficial for some people listening to this. For others, it could be that you point them toward a new build if they really wanted to enjoy the benefits and it was such a big thing to them. The negative gearing.
Bill for 800,000,
Yeah,
but we can't.
absolutely. And if they were somehow to find the unicorn that fits their budget, right? And there's someone that can support things cash flow wise until the tax return period comes and they get their return. It's a really good play for them. But it all just really depends. Some people are probably mute with negative gearing as a whole point and aren't interested in company borrowing because there's associated costs to companies and compliance that you need to be on top of each year to make sure that you're not falling behind and therefore paying a lot of penalties and the costs just blow out all in all. But some of those might have high yield plays and they would have made a vision that they'd be positively geared in a year or 2 years' time anyway, and that can probably just be continuing on the same strategies despite what happened last night.
Do you see self-managed supers becoming more popular when it comes to property investing?
Absolutely. And why do you think that is? I'll ask you the question.
I think it's because, one, it's going to be better for tax effectiveness.
Absolutely.
A lot of people like to be in control of where their money is these days.
Absolutely.
They don't necessarily trust the stock market.
Yeah.
If you buy property, you are in control of what you're buying, where you're spending your money. You can pull it out and change it and buy another property. If you're in business, a lot of people use self-managed super to buy the building they're in and then rent it back off each other.
Yep.
So I say to people, again, the same as you, what's their circumstance? But people who like to be in control of their money normally use a self-managed super and don't rely on a financial planner to tell them where to go and how to spend it.
Mate, you're spot on, because I think the way it's designed, right, if you can just imagine a certain clip of everyone's wage or PAYG pay goes to at the moment, by design, the same funnels down to retail industry super funds, right? And then these super funds, I think it's also by design. There have been recent audits and changes that have happened where visibility is a bit better. But when I first joined the workforce, up until maybe 10 years into the workforce, I never knew what my balance was at any given time. If you asked me, I could give you a rough guess off the top of my head. If you told me what I was investing in, what my fund managers were investing the super in, I could say it was probably an asset class like shares. I wouldn't tell you what it was. If I chose certain strategies like an aggressive strategy or a passive one. It might be blue chip, it might be a low cap stock. I could never tell you exactly what it was or if it was an ETF, etc. Some people might have a better grasp of it than I. But the other thing I know for a fact, probably 99% of SMSF investors that I've come across, if I ever ask them the question, so do you know how much insurance coverage you have, right? The bottom line is fund managers have certain deals with insurers to write these policies with them. Sometimes it may not benefit to the best degree the people's money that they're handling, and whether they make a win or a loss on the year investing the super fund money, they will still get their management cuts, right? So it's not performance based, and it's definitely not. Doesn't seem like it's a best interest space. There is a small caveat to that there were a handful of super funds that actually had to disclose to their investors that they weren't a good financial decision to stick with a few years ago, and I was one of them. I was Westpac staff, and we had a certain super fund tied to that. Majority of the Westpac
Bank, and we were just told had to go into their super, and that was it.
Yeah, that's right. That's right. It's all down the same funnel, and got a letter one day to say it's not a good decision to stay with us, the super fund that they were associated with, and made the change. So it's one of those things, but that was a good 12 years into my career before I made that change, right? So I think self-managed super fund, as you mentioned, taking back control, understanding how strong the residential market or even the commercial real estate market is, the $13 trillion residential real estate market. It's a strong performing, ever growing market.
Over 5 years, it doesn't go back.
Yeah, and I've seen examples of customer where they've held senior roles in a big four accounting organisation, 600k super. I've got a 32-year-old investing their super for 10 years, 900k super after the sale of 2 properties. So it's just taking control and putting in the right, applying the strategies that you know and that you can hold yourself to account for. Game changer.
So a couple of quick questions before we start to wrap up. The normal property market for owner-occupiers.
Yep.
In 12 months' time, when it all starts to trickle down, investors start to move their property portfolios, do you see it having a positive or a negative effect on the market in price or availability?
Oh, I think it's still the property prices will still tend to go up. I think there's many factors. We've got to really look into net migration and migration coming in.
Yep, demand.
Absolutely. Like we've got a trade issue and a supply issue. We seem to be trying to source these trades from overseas, but I guess one thing that we don't really talk about enough is that when you bring the trades from overseas, it seems like these tradies want to stay here. These migrants want to stay here. So you've got to build more houses for those trades that you brought over to build these houses, so right?
We're chasing our tail.
We're chasing our tail, and I don't know what the correct solution is for that, because we do have a trade shortage. Although this current one we've seen playing out for a few years has seemed to further widen the gap between supply and demand. So I think that supply shortage would continue to drive prices up. We still have the first home guarantee, 5% deposit scheme. Those changes back in October, they've
fueled the market.
Oh, yeah.
They've pushed a lot of first home owners out.
Yeah, absolutely. And it's just the first home owners is an interesting category now, because after October, it was, before October, it was $125,000 single income, $200,000 per household. Seemed like it targeted the people that needed the help more. The focus after October, where they removed the income ceilings, and you could apply, it looked like first homeowners when you push them out. Well, what's a first homeowner now? It could just be someone running a business earning $2 million profit, competing with a 50,000, but they're both first homeowners. Like, it's so interesting
because they've always rented one of their own.
Absolutely. I think it's really harming the working class quite a bit, and first homeowners from the working class, and it's quite an interesting thing. But that scheme, time after time and study after study, shows that the properties within those median, those qualifying property price caps are driving further and further up and outpacing the property price of those outside.
Well, once you hit over the 800,000 in stamp duty in New South Wales, it's. Do you think now with the banks, first the big four that control quite a lot, but they are shrinking on the mortgage side of it.
Yep.
Do you think that they will tighten serviceability rates based on this budget in the next 12 months? Because we have interest rates rising, we have demand that's a little bit all over the place.
Yeah.
Confidence in the economy is dropping.
Yep.
Unemployment by the government's own things will rise to about 5%.
Yeah, well.
So do you think the banks might get a little bit, the big four might get a little bit conservative? And do you think that might open the door for more non-bank or left-of-field bank lenders who don't have the overheads to come into the market and offer unique products?
Yeah, mate, great question. I do believe so, particularly through the negative gearing impacts. Naturally, banks, they have household expenditure measures and benchmarks. They get updated with inflation reports and with the movement of the economy themselves. And, sorry.
It's okay, we've got one of the advisors in who's been outside in the rain. So
yeah.
Oh, we've got the other one behind us too. These are your two high-paid advisors.
No, but what I'd say is that with inflation going up in 12 months, if we fast forward and they forecast them to be at about 4.8%, naturally the benchmarks of expenses will go up. The drastic changes to negative gearing, I think the lenders are going to have to give a lot of guidance to the broker network on, indications of whether it's a new one of the three categories: a property established dwelling investment that's purchased before last night, one after last night, which will have the negative impacts on serviceability, and then of course the new builds that are after that will forever get the negative gearing as it currently stands. That won't be impacted, but those definitely that are investing in established dwellings, they're going to lose quite a bit of servicing.
Do you think then that investors, where a lot of them will look, say, hypothetically, a base load of 4% gross yield, as they don't like to go below, most want a high, do you think a lot of them may start looking, well, I need to get 4.5% gross yield to cover the increased expenditure, and that then again will push rents up?
Yeah, absolutely. I think high yield options will become a bit more prominent, right? And we used to have the balance between capital growth and yield. Sometimes it'll be higher growth, less yield.
And people are more happy to do that.
Yeah, absolutely.
Not now.
And we think about new money business that will come into the big four banks. You posed the question earlier. Sorry, I didn't answer, but it was about the non-conforming lenders, the specialist lenders, non-bank lenders. They're always quite agile in bringing in incentives to make sure that business still comes in, and it's great for the broker market and great for the investors to always have options. I think they'll come out with something, because a lot of new money for the established dwellings that needs to still be an option and still needs to have the borrowing products to suit it to combat and not have to settle for just a new build with all the rising build costs and the premium prices that come with it. I think they're going to come in with some plays and give some good options, and therefore probably minimise the impacts to serviceability, if at all. So,
I was watching you when I came in, I had a look, and you've got quite a big team here. And if you see the software and how in-depth your team at Mencken Finance goes into the behind the scenes before they give their clients what they need and guide them in a certain way, do you think from yourself, if someone's coming to you in the next 12 months, you'll maybe change the way you look at investments for your clients, and your advice may need to sort of be a bit manipulated compared to where it was in the last 12 months?
It will need to tweak for sure. The same sort of questioning, the same sort of digging and unraveling of what their intentions are and their visions will always be the same openers with any of our customers. We're always about building strategy and trying to back it with data.
You do, yeah. You're amazing at that.
Oh, thank you. Very kind. But but what they're trying to achieve, obviously, just with these policy changes that have just come back, if it were, for example, the customer that wants to do a short-term gain and quickly sell, right? The 50% exemption probably no longer being a factor to hold longer, it might be a play for them. It might be someone that wants to buy an established dwelling and wants to look at options. We might need to steer them a certain way to be able to get that certain outcome. And there'll be probably a few less options and a few more opportunities rising on either side.
So what's your best? As we're going to wrap it up, what's your best advice now when people come, they ring you and say, Michael, what do? I want to get into investment. I want to buy a couple of homes, rent them out. Do you still say that's the best way to go, or do you push them towards commercial? What are you going to say to the investors that come knocking on your door and say, help, I want your help, I want to get into the market? What are you going to be doing?
Yeah, absolutely. I'd be looking at their borrowing capacity first and foremost and understanding their position. But if it's something like they want to invest, then we'd be there to present options, whether it's new dwellings, established dwellings, and help them point to the right place. The main thing is if their goal is to build capital and equity over a year, 2 years' time, with data, we'd be able to point them that way either way. We still believe that property prices do go up, and by end of 2027, we're going to see the rental expenses that passed on and the supply shortage, probably the demand and supply further widen despite the budget allocation toward it. And we're just going to see what property prices look like, and it looks like it's just going to keep going up. So I think there's still a lot of capital and equity to build in that segment.
That's awesome, mate. So as we wrap up, how do people get in touch with Mencken Finance? Because you've got a great team here and they're very impressive.
If you don't mind, I'll give you those details in a second, but I want to ask you, what are your predictions by the end of 2027, Rob?
Yeah, see, this is what happens when you don't, this isn't a sell. See, as we always say in our podcast, we don't pre-plan, we don't think. Look, I think, in honesty, rents will rise. I think a lot of investors will move out because for the tax reasons. They'll have to readjust what they're doing. My worry is that people will sell out, and what they'll do is it's going to be more better for them when it's selling a property if it's vacant.
Yeah.
So they will start to give termination at the end of people's leases so they can sell the property vacant possession, which is scary then because you're then getting a whole heap of people then going into the market. Yeah. And there is less and less market, which is going to push rents up. And I think that's a very scary. I don't think the government's looked at that part of it. I'm all for increasing supply. I don't think the way they're going about it's the right way. I think we have to look at the costs to bring to market. It shouldn't be costing what they do to bring the land to market. All the builders tell me the biggest problem there is the cost of the land, not necessarily the build. But of course, what we've seen in the last 3 months, the cost of build is also rising. Yeah. I think negative gearing needs to stay. By all means, bring it back for the professional investors, got 5, 10, 15 properties, that's different. But for 1, 2 and 3 properties where they're trying to build wealth for their future, either to buy their own home or to retire, I think we should be encouraging them, not discouraging them. I don't believe in taking wealth and making it hard for people to make money if it's going to better the whole thing. I mean, one guy actually said to me, well, and I agree with him, it was a great idea, is if you've got a rent investor and they haven't purchased first, don't have any capital gains tax on their first investment property if they're selling, and that money's going straight back into them building.
Yeah, absolutely.
I mean, let's look at the things different. Let's throw it all out and look at it, not look at it the traditional way. Last night's budget was very similar to a budget that was proposed and a policy was proposed 6 or 7 years ago. We've got to be different now. The world's changed.
Absolutely.
And I think the best thing I would say to a lot of people who are looking for investments is, yes, I can get them a great property. I can get them whatever they really want, matching their goals, but go and see your accountant and go and see an investment firm like you guys to get proper advice before you do anything. You've got to know where you're going.
Absolutely.
And when I see too many people out there in the market, and I see them at auctions, I see them when I'm going to look at properties myself, and they don't even know the basics around how to buy property. They just look at, I'm going to buy a property that's close to where I am. Well, what's the yield? What's the vacancy rate? What's the absorption rate? What's the crime rate? And they go, what do you mean, what's crime rate? Also, crime rate has a direct influence on your insurance.
Absolutely. Why would you live in a neighbourhood that's just full of crime?
I mean, look at these things.
Yeah, absolutely.
That's where you get I mean, you don't turn up to court without a lawyer.
Absolutely.
Don't go and buy a property without seeing professional advice.
Absolutely.
That's what I think it's going to be like.
Cool. And if we can, before we give out our details, you spoke about alternatives and different ways of looking at things. So what were Nathan, who works with us, used to be my executive manager at Westpac, right? Yeah. And he used to come. Every time I came to him, he said, "Don't ever come to me with a problem if you don't have a solution."
Yes, I agree.
So, what would be your solution if it wasn't to scrap negative gearing for established dwellings on investors? And
I would limit the top negative gearing to say 3 or 4 properties.
Yep.
And then have a sliding scale afterwards.
Yeah.
I think we need to incentivise people in large homes to come back down. So if you have a big home and then you want to downsize, you could still be paying $40,000, $50,000, $60,000 in stamp duty.
Yeah.
Well, hang on a minute. That's, we need to get people out of the big homes who want to, get them an incentive to come back down to so people can trade up as much as trade down. I think that around self-managed supers, they need to make that more attractive. So people, especially if it's purely for the sake of being self-funded when you're a retiree. Because if you're going to be self-funded, you're not then a burden on the government.
Absolutely.
And that would then, I believe government should be there to help the people that need it.
And not just everyone.
Not just everyone. I mean, I know why they want to do it, but I would rather have a whole heap of self-fundeds, and then it allows us to heap the people who need a help up, who need support, and we need to look after. We're a wealthy country, and we don't do enough to look after the people that need it. Yeah. And I think that should be our focus. But don't penalise people for being successful. Don't penalise people for wealth or smart decisions. And it doesn't matter which brand of government. I think that they really need to have a good, long, hard look and put the incentives in place to do that. When it comes to supply, we've got to work out a way to get the land price down. I mean, it's simple as that. I spoke to a developer who said, unless I can build a tower of 20 stories, it's not worth me to do it.
Yeah.
Now, come on. Now, you and I know how much, when you're paying $800,000 a unit, 1.2, and it's higher, you get them all. And if he's saying, I've got the land, I'm just land banking.
Yeah,
I can take you to every major city in this country. There's massive blocks that should have high-rise on it. And there's nothing there because they can't make the money. Let's find out why they can't make the money and make sure that that money's coming back into Australia, not disappearing overseas. Let's reinvest back into our country and make it worthwhile. That's how I would look at it.
Yeah, very good, very good. All right, well, awesome, mate. Well,
see, it's flipped now. He's interviewing me.
That's right, that's right. There's one last take I'd say that you didn't touch on. I would have liked to see, and I was hoping this, because this was floated around a couple of years ago, that if we're talking about the inequality between investors and homeowners, and the main benefit was negative gearing. Well, why didn't we look to apply negative gearing to first homeowners for the first 5 years or something?
Because there's no capital gains tax on.
Yeah, absolutely, on the primary residence, but
and it should never ever be.
Yeah, absolutely. But it's just if this was really the play, and you wanted to level the playing field, right?
I can understand what you're saying there.
Yeah.
I think it's something we could look at. The problem is that the government has to find a way to replace the money that it loses by doing that.
Reduce the deficit.
So it's fine to say let's do it, which I think is fantastic for first homeowners. But if we pull $1 billion out of the government's budget, we have to replace it.
Yeah, absolutely.
That's just good fiscal. Doesn't matter who's in, you've got to replace it, or you've got to cut it from somewhere. So either cut $1 billion, or you find another way to make $1 billion.
Absolutely.
Either way, we've got to find a new way.
Yeah, agreed.
Mate, thank you so much for being on the podcast. It's been enlightening. I hope everyone finds it interesting. We touched on just about everything. One final message before we go.
Yeah, guys, just if you ever want to reach out, Instagram, it's @Mencken Finance. I've got a personal handle that's on there. It's Menks YNWA. We've got a team of professionals ready to help. Come reach out to us. We'll be able to navigate this.
Thanks, guys. You all have a groovy day, and we'll catch you in a couple of weeks with our next podcast. Thanks very much.